This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. And if you know about this channel, I often reach out to experts in areas I have zero experience. Taylor is one of those examples. He is the Wall Street guy of my expert panel. So let's welcome Taylor to the show.
Don't understate yourself. Zero experience is not the facts. Wall Street is a lot about macroeconomics, and you are sharp when it comes to that category.
Well, I appreciate that. I love our conversation because, frankly, we don't always agree. And
No,
I think healthy debate is very interesting. And one thing I did research over the weekend, because I'm often seeking counter information because I realize I have blind spots and I hate tunnel vision. In fact, I think Peter Schiff, the ultimate gold bug, is a perfect example of what I don't want to be, right? Gold is always the answer. Shut up. It's not always the answer. It's the answer sometimes.
It's been pretty rare, honestly, over the long term when it's been the perfect time to buy gold. There have been times. Don't get me wrong.
The broken clock is right twice. But
that's
again,
exactly right.
I don't want to be Peter Schiff. So that's why I'm constantly seeking. The reason I bring this up is there's a Wall Street guy named Whitney Thielsen who put out a webinar the other day talking about June 10th, the inflation surprise. So I clicked on it. I watched it. It's about an hour-long webinar marketing nonsense. But June 10th is an interesting headline because if you don't know what June 10th is, that's CPI day, right? So about 30 minutes into this freaking thing, after he's marketed his newsletter 12 or 13 times, he finally says what this inflation surprise is. And he says that he is predicting, and this is like, what is it, like 3 weeks away, 2 weeks away, that inflation is going to surprise to the downside.
Right.
And I'm like, dude, I get to talk to Taylor on Monday. We're going to talk about this. So again, his idea is inflation goes to the downside. It's something in the sevens, like the high sevens. So again, 8.5, 8.3, something in the sevens. Clearly at that point, a trend, right? A single point is not a trend. Now we have a trend. And basically his point, which I feel is uber aggressive, risky, and stupid, is buy the dip. Because if you're right, if inflation goes down, it gives the Fed permission to slow down, if not pause. And if that is the setup, you could get a wild rally after that. You and I disagree about what might be ahead of us, but I do realize that I could be wrong. And here's another guy saying that Taylor's right. What do you think of all that?
Yeah, I tend to agree. I think inflation slows. I don't know that you get this massive rollover in inflation. And I think that what would come along with that would be a Fed slowing. But I don't necessarily think that that's coming out. Right now, you're seeing oil move the opposite direction. So oil spiked, set, and now it's back up again. And as you go into summer, people drive more, all of that. Gas prices are ridiculous, and they're getting shown everywhere right now. They're record highs. But what is more to that is that everything that we consume does have a gas component to it because it's how it gets to the store that you buy it in. And not to mention, it's not gas, it's oil at the base of it. Petroleum-based products are so widely used. Yes, we're trying to get away from in general, but that is a slow transition. So to your point, that's an inflationary pressure right now that I think will abate. I do think that we have access and the ability to go in and drill more. I think that some of
it ain't going to help for May. It's not going to help.
No, it's not going to help in the short term. In the short term, it's absolutely not going to help. But it's funny, and this is not a political comment one way or the other. We have the ability to go in and drill. Definitely. We do have the ability to turn on the spigot relatively quickly and start producing. Mm-hmm. But to your point, that's not going to happen here in this next print. And none of that is going to show through. You have seen both nat gas and crude oil rig count increase consistently for the past 7 months. But it has not hit that hockey stick point where you're going to say, okay, now this is going to cause prices to roll over. So we haven't gotten there yet.
Yeah. Well, I mean, let's just, I came out early saying that I think CPI is going to go back to 8.5, which my opinion of where inflation goes, again, if I'm right, the Fed has a completely different answer, right? If inflation goes 8.5, 8.3, 7.8, they have cover to slow down. If I'm right, 8.5, 8.3, 8.5, dude, the chances the Fed goes 75, I think, are greater than 25.
If you're right, it's a scary proposition if you're right.
Yeah.
I hate to say it really is. It's a scary, because if the Fed goes 75, it's going to blister the market because the Fed has overtly said we're not going 75.
Exactly.
Jay Powell came out and said we
Twice
are
he
not
said
going
that.
75.
Yes.
Correct.
Yeah.
Yeah, I go back to the macroeconomic thought of the entire thing. I think that a lot of this was caused, and this is over publicized, so this is no new news, that a lot of this is caused by the supply bottlenecks that we've seen. Those are starting to alleviate some. Labor is starting to become a little bit more of an interesting topic, i.e. some of the calls we had last week were a little bit of a question. You see Walmart come out and say, we actually hired too much.
Amazon too. Yeah.
Amazon as well,
Overhired.
saying we hired too much because the coronavirus had this question mark of, we don't know who will be able to come into work, who won't, so we'll overhire. And then all of a sudden they're blaming profit margins on hiring too much. And you're like, hold on, I thought there was this supply shortage of labor, et cetera.
Yeah.
So I think there's a lot of these macroeconomic forces that are starting to alleviate themselves. And I think that with that, the supply chain bottleneck conversation is going to start to fade into the rearview mirror. And that's the biggest inflationary pressure that I think is going to abate. Doesn't seem like you agree.
I don't agree. I mean, I don't think we've seen the ripple effect of Shanghai being shut down for 9 weeks. That's a whole nother mess coming. Does Beijing shut down? And, oh, by the way, let's not forget, the macroeconomic view of the breadbasket of Europe being shut down, no planting, no harvesting, can't ship what they got. Dude, I am, yeah. So again, oil and gas, we've already hit. They're up this month. Diesel up this month. So I think,
by the way, though, I don't see much reason for those to continue to go higher. I can't create the case that, and there's a lot of people out there creating the case that oil continues to go higher. What is it? We have war. Yeah. We already know that the Middle East Middle East isn't the right word. The Eastern Bloc is a nightmare, right. And that's causing Europe to then start to derive oil from places that they don't want to derive it from or haven't historically, driving up prices. Mm-hmm. We have the summer. We know that's here. Mm-hmm. We have all of these underlying components that are already there.
Yeah.
And now,
so that's just one component. So that's one component.
So what if we get a slowdown in the economy, though?
Well, again, that's not May. That's not the June print for May.
Perfectly fair. Yeah. And you know what? Maybe that's a fair, I have to compartmentalize what we're talking about here. We're talking about a May print, which again, correct. I still do think continues to trend downward, but
so let's talk about the May print. So oil is not helpful. Oil is up for May.
Oil's not helping. Correct. Fair.
Right. Food's
not helping either.
Not helping. Rent.
Yep.
Rent is not helping in a big way. And the real reason is it has a 6-month lag how they do it. The heavy input of rent is just starting to show up. You go back and look at the 2 or 3 months of rent, it is increasingly bad. And that's just how the calculations work. And again, it eventually is going to jump. It might be the June print.
I think the consumer is getting weaker and the consumer.
Oh, I do too, but that's not the June print.
Yeah, but I think it's going to start to bleed through in it. I really do, because I think what you're going to see is that retailers, et cetera, because of inventory stocking that they shouldn't have done, are going to cut prices.
They doubled and tripled orders. Yeah, exactly.
Yeah, and it's silly that they talk about missing trends. It's like, well,
you got it 3 months late, buddy.
Yeah, it's that, and it's also the fact that, like, you can call it missing a trend, or you can call it people going from buying your TV at Target to looking at the value branded groceries at Target. Like, well, that's not saying, I hate it when they say the consumer is strong. The consumer is strong because traffic in their store is strong. Your numbers are showing the consumer is weak.
Yeah.
I think it's tough. The Target one is the one that really confounded me, where they said 15 times in the call, strength and consumer, strength and consumer. You're saying that, but your numbers aren't saying anywhere near that.
Yeah. The only example they had was luggage.
Yeah. Awesome. Okay. Yeah. We can travel again. We get it.
Yeah, exactly. And that's why I'm calling this the K-shaped summer. Because again, we've had the K-shaped recovery. We've had this, we've had that. I think if you're in the top end of the K, you're partying like it's 1999. Your staycation, 2 years of staycations are over. You're going to Mexico or Europe or wherever you're going. But that's, I don't know, 30% of the economy, 40%. Then the other half of the K, the bottom end, is they're trading down. They are buying less discretionary because there's just no money left at the end of the month. It's terrible. So I would think in general, the consumer is a lot weaker than the numbers look at.
I don't understand how this confluence of events can lead someone to go, yep, consumer's going to be strong based on this. Market's down 20% from its peak. Mm-hmm. Simultaneously, things cost 10% more.
Yeah.
Like, granted, those are both round numbers that are used there and not
Yeah.
precise. I get that. But directionally, how do you look at that and say the consumer is going to continue to be stronger than it was in the past?
Yeah, well, that's going to be video number 2. Consumer confidence will work in the wealth effect, which is just what you talked about. I think this all ends really, really badly. You and I just agree on timing, which is really interesting.
Yep. Yeah, we totally agree.
Yeah. So folks, again, why we wanted to talk about June 10th is it could be a really important day. I could be completely wrong. And hey,
I will
take a
say
shot.
this. If it goes up at all from where it just printed,
Yeah, if it goes up from 8.3. Yeah.
If it goes up from 8.3, because the market, I think, is almost fully in the camp that it's starting to roll over.
Yeah,
and
the
that we're
roll
starting
yeah.
to.
Inflation
So also,
peaked.
let me rewind and say one thing though. The numbers that this month will come off of, the inflation numbers that this month will come off of, also include higher numbers on the front end.
Correct.
Meaning a year ago.
Correct.
So the numbers are going to be higher, and that's supporting a case of it coming down.
Yeah, the
a
base
little more
effect.
as well.
Correct.
The base effect, exactly right. Because if it was, I think we made ourselves clear there. So yeah, but what I'm saying there is, if you're right and you do get a reversion back upwards of inflation, it'll be interesting. The market will not take that well.
Well, again, I think it's a 2-step process, right? If I'm right, it goes 8.4, 8.5. Again, the beauty about this print is it's pre-Fed meeting. The last one was reversed. You had the Fed meeting first, then CPI. Now we have CPI. So again, let's just play it out. Fed goes to 8.5, or the CPI goes 8.5. Let's just pretend. Do you think the Fed has to go 75?
I don't think the Fed can. I think the Fed can't.
Even if we got in 8.5.
Yeah, if it went 8.7, which I think it would be really, if it went something really big, then they could. But for them to submarine the market after telling you we're not going 75 basis points, I think is like a death cross.
Okay,
that's a tough thing.
So let's play it the other way. Let's say it's 7.5. Do you think the Fed comes out and says, "Hey, we'll give you your 50 in June, but July 50 is off the table"?
No, I think they probably stay the course at this point. I think they very, very overtly have said 50-50. I think to get them off of that, it needs an exogenous event on one side or the other.
Okay. All right. But again, so
this is to your point, this is a really cool one because we've now seen what the market has said has been the peak of inflation, and it roll over. If it reverts back up, the market's wrong and inflation hasn't peaked.
June 10th. It's going to be a fun day. I'll be up early for that one.
I'll stand by this. And this is a little bit of a Cathie Wood-ism. And you know my feelings. You know my feelings on Cathie Wood. You know what they are.
Yeah.
Technology is the ultimate deflationary pressure over time.
Agreed.
And so it will right itself. Right now, because we're on inflation, the 5-year forward has come down. The 5-year forward inflation is 2.22%. That's the market saying 5 years from now, inflation for a 5-year period of time will average 2.22%. That's really low relative to where we're at. We got to start moving in that direction if the market is at all right. And those numbers have come down over the last couple of weeks.
They're trending down. Absolutely. Well, Taylor, thank you very much for doing this. Where can people find you?
Look at us at Life Goal Investments on Instagram. We're putting out daily content there. So at Life Goal Investments on Instagram.
It is in my feed. I look at it every day. You guys are doing some really good work. Thank you.
You're the man, Michael. Thanks for having me.